Today we will do an in-depth analysis of Varun Beverages Ltd as of 06 November 2025. Disclaimer: this video is for education and information only. It is not investment advice or recommendation to buy, sell, or hold any security. I'm not a SEBI registered advisor or research analyst. Do your own research and consult a licensed professional. The data points used here are drawn from public company disclosures and reputed market sources as of 06 Nov 2025 and may change over time. Pause. Let's talk about what the company does. Varun Beverages is PepsiCo's key bottling and distribution partner. It manufactures, bottles, and distributes beverages under PepsiCo brands across most of India and several international markets. The portfolio covers carbonated soft drinks such as Pepsi, Pepsi Black, 7up, Mirinda, and Mountain Dew, non-carbonated beverages like Slice and Tropicana juices, 7up Nimbus Lemonade, Gatorade Sports Drink, and the Sting Energy Drink, and packaged water under the Aquafina brand. The company has expanded geographically over 3 decades and now holds exclusive or near-exclusive rights across 26 Indian states and 6 union territories and in multiple African and South Asian markets. Let's talk about their products. The product set spans 3 large buckets. First, carbonated soft drinks remain the core, led by Pepsi, 7up, Mirinda, and Mountain Dew, including zero-sugar variants like Pepsi Black. Second, non-carbonated beverages include juices under Slice and Tropicana, Tropicana 100% and Delight, lemonade under 7up Nimbus, functional drinks like Gatorade, and energy via Sting. Third, hydration through Aquafina packaged drinking water. In the last 12 to 18 months, the company has also begun building 2 new adjacencies, a snacks line under arrangements such as Cheetos in Morocco and Simba-branded snacks in parts of southern Africa, and separately, exclusive distribution of select alcoholic beverages, for example, Carlsberg brands in certain African markets. These are small today but designed to leverage the same cold chain and last-mile network. Let's talk about the revenue mix. By category, the sales mix is still dominated by carbonated soft drinks at roughly 3/4 of volume. Packaged water has climbed into the low 20s% by volume, with the balance from juices, energy, sports, and other non-carbonated beverages. Realization per case in recent quarters has hovered around the high 170s per unit case, with quarter-to-quarter movement driven by product mix. More water dilutes realization, while energy and premium formats lift it. By geography, India remains the anchor at roughly low 70s% of net revenue, with international markets, largely Africa plus Sri Lanka and Nepal, contributing the remainder and growing faster due to recent acquisitions and capacity ramp-ups. Pause. Let's talk about stock performance since listing. VBL listed in Nov 2016 at an IPO price of $445 per share. Adjusted for splits, the share price has appreciated more than 20 times from the listing price to its 52-week high, translating to an approximate compound annual growth rate in the high 40s% since IPO. Notable drawdowns include the COVID-19 shock in early 2020, a weather-linked pullback in mid-2023 when unseasonal rains hit the core summer quarter, and a sharper correction in 2025 when an early and extended monsoon dampened peak season volumes. From a 52-week high near 664 to a 52-week low near 420 in August 2025, the drawdown was roughly mid-30s% before a partial recovery. Pause. Let's talk about revenue trend in the last 3 years. On a consolidated basis, revenue from operations grew from about 13,391 crore in CY 2022 to roughly 16,321 crore in CY 2023, and further to around 20,481 crore in CY 2024. That implies a 3-year revenue CAGR in the low to mid-20s%. Through TTM 2025, growth moderated versus the strong 2024 base because of weather headwinds in India, but international markets offset part of that softness. The occasional quarterly dip, such as in the core summer quarter of 2025, was linked to unseasonal rainfall and not to structural market share loss. Let's talk about whether they are adding new products and services and the expected mix. 2 additions stand out. First, packaged snacks under arrangements such as Cheetos in Morocco and Simba snacks in parts of southern Africa. Second, exclusive distribution of Carlsberg beer in select African countries. Management frames both as adjacency plays designed to utilize existing logistics, coolers, and route to market. Near-term revenue contribution is small, likely low single digits as a share of consolidated sales through 2025 to 2026. But over the next 12 to 24 months, the combined mix could move into mid-single digits if early pilots scale, with beverages still contributing the vast majority. Core guidance continues to emphasize double-digit volume growth in beverages, stable to slightly improving margins, and selective expansion where PepsiCo refranchises. Let's talk about order book or backlog. This is a fast-moving consumer business. It produces to stock and sells through millions of retail outlets. There is no traditional order book or long-cycle backlog. The relevant capacity lens is utilization and summer preparedness, preseason inventory, cooler placements, and distributor stocking, rather than a contracted pipeline. Let's talk about why revenue dipped when it dipped times. Where quarterly declines occurred, the primary cause was weather. An early, prolonged monsoon in 2025 reduced on-the-go consumption and footfalls, especially in North and West India, precisely when April-June contributes a disproportionately large share of annual volumes, often around 40% of the year. The softness was not due to pricing actions or loss of availability, and was followed by a rebound as rains receded. Let's talk about EBITDA trend in the last 3 years. EBITDA expanded from roughly 2,830 crore in CY 2022 to about 3,690 crore in CY 2023, and to approximately 4,800 crore in CY 2024, implying a 3-year EBITDA CAGR in the low 30s%. Drivers included operating leverage from volume growth, premiumization into energy and zero-sugar variants, backward integration in preforms and crowns, and relatively benign input costs in 2023 to 2024. In 2025 TTM, EBITDA growth paused in the rainy summer quarter, but recovered with better mix and lower finance costs. Let's talk about EBITDA margin trend and explanations. EBITDA margin improved from the low 21% range in 2022 to about 22.5% in 2023 and near 23.5% in 2024. Quarter-to-quarter margin moves reflected mix. Higher water share and international pricing pools compressed the percentage, while energy drinks, premium pet, and efficient plant utilization expanded. In the 2025 monsoon-impacted quarter, margin dipped by tens of basis points versus the prior year but remained above 23%, supported by cost control and procurement efficiencies. Let's talk about debt to equity and whether debt is high. Following a large equity raise in late 2024 and active deleveraging, total borrowing stepped down to roughly 364 crore versus shareholders' equity of about 16,610 crore at year-end 2024, implying a debt-to-equity ratio near 0.14 times. With cash and equivalents around 2,266 crore, net debt approached zero. On a net debt to EBITDA basis, the ratio was close to 0.0 to 0.1 times, very comfortable. Versus Indian FMCG peers that often run net cash, VBL now looks similarly light on leverage. Debt is not high. Let's talk about cash flow conversion and a peer-style verdict. Operating cash flow rose to roughly 3,381 crore in 2024 versus about 2,391 crore in 2023. Cash conversion of EBITDA into operating cash ran around 70% in 2024, reflecting seasonal working capital needs and the inventory build ahead of summer. Free cash flow fluctuates with growth capex. 3,800 crore type capex years will naturally compress FCF. Versus classic asset-light FMCG names like Nestlé India or Dabur, which often convert 80 to 100% of EBITDA to cash due to negative working capital, VBL's conversion is lower. Versus manufacturing-heavy consumer names, it is healthy. Marking this good versus high-growth, capex-driven peers, an average when stacked against the most cash-rich packaged foods companies. Let's talk about the stock price trend in the last 1 year. Between NAV 2024 and NAV 2025, the stock traversed a wide range, a 52-week high near 6663.6, a 52-week low near 419.6, and recent prints in the 470 to 500 zone. The year-on-year change is roughly negative high teens to about negative 20%, largely explained by the monsoon-impacted summer quarter. After Q3 results signaled a pickup in October volumes, and after the Africa beer distribution announcement, the stock rebounded roughly high single to low double digits from the trough. Let's talk about whether promoters recently bought shares in POR. Promoter holding led by the Jaipuria family stood around 59.4% as of Sep 2025. Over the past year, the promoter percentage edged down modestly due to equity issuance and dilution rather than open market sales. There were no reported open market promoter purchases in recent quarters. Pledging is negligible, about 0.04% of promoter shares, so roughly 99.96% are unencumbered. Let's talk about valuation through PE, price to book, and EV to EBITDA. On trailing 12 months, the price-to-earnings multiple sits around 60 times at a spot price near 475. On forward FY 2025 estimates, that moderates into the 40s if double-digit earnings growth resumes. Relative to peers, Nestlé India commonly trades above 70 to 80 times, Tata Consumer often in the 70 to 90 times band depending on cycle, and Dabur around the high 40s to low 50s. By this lens, absolute valuation is rich, versus the faster growth profile it is within sector norms. On price to book, VBL trades around 9 to 10 times FY 2024 book value per share near the low 50s. Dabur's PB runs around the high 7s to 8-9x, Tata Consumer roughly mid-single-digit PB, and Nestlé's PB appears optically very high due to its small accounting equity base. Given VBL's 20% plus ROE, the PB premium is explainable but not cheap. On EV/EBITDA, TTM sits roughly in the low to mid-30s times, with forward multiples falling into the high 20s if EBITDA grows mid-teens. Many Indian consumer peers cluster between high 20s and 40s on EV/EBITDA, with Nestlé higher. Here, VBL looks neutral to slightly more attractive relative to peers when growth is considered. In summary, on PE and PB, lean overvalued in absolute terms, on EV/EBITDA with growth, closer to fair. Pause. Let's talk about variables and risks with quick flags. Seasonality, high. April-June can be around 40% of annual volume. Abnormal rainfall or mild summers can dent yearly outcomes. Input costs, medium. Sugar, pet resin, fuel, and packaging volatility can swing gross margins by hundreds of basis points. Backward integration helps. Customer concentration, high. The franchise model is linked to PepsiCo brands and concentrate economics. The partnership depth and term mitigate but do not eliminate this dependence. Capex and working capital intensity, medium. New plants, coolers, and seasonal buildups are capital hungry. Utilization and asset turns are the guardrails. Policy and regulation, medium. Health taxes on sugar, GST rates, FSSAI norms, water use licensing, and plastic EPR compliance are ongoing factors. Foreign exchange, medium. Africa and South Asia earnings translate into INR. Currency moves can dilute reported growth. Execution, medium. Integrating new territories, ramping new plants, and standing up snacks and alcohol distribution require disciplined execution. Let's talk about whether the business is cyclical or seasonal and the cycle therefore. This is not a classic multi-year cyclical story. It is a seasonal one. Demand peaks in the Indian summer, slows in monsoon, and softens in winter. The seasonality is partially hedged by growing southern hemisphere exposure, where summer falls in India's winter. The annual operational rhythm is therefore inventory build and cooler deployment in Q1, peak sell-through in Q2, normalization in Q3, and maintenance in Q4. Pause. Let's talk about latest news in the last 1 to 2 months. Key developments around late Oct 2025 included third quarter results showing year-on-year revenue growth in the low single digits, EBITDA holding broadly flat with margin in the 23% zone, and profit after tax rising in the high teens %, helped by lower finance costs. Management also highlighted a rebound in October volumes into double-digit territory as rains receded. Separately, subsidiaries signed exclusive distribution agreements with Carlsberg in select African markets, marking a measured move into alcoholic beverages distribution. Snacks manufacturing in Morocco scaled to full operations, and a Zimbabwe snacks facility is underway. The stock rose high, single to low double digits on result day before consolidating. Pause. Let's talk about analyst ratings and reviews and when they were given post-results on 29 to 30th of Oct 2025. Multiple brokerages reiterated positive views with target prices clustered around the mid-500s to high 500s. For example, in the 575 to 595 range, while acknowledging the monsoon-affected quarter and the improving October trend. Earlier in April 2025, at least one large domestic brokerage carried a target near 670, justified by an 18% to 27% revenue and profit CAGR framework over CY 2024, CY 2026, and by the correction improving risk-reward. Across houses, the stance remains growth intact, watch weather, mix, and execution. Let's talk about which mutual funds hold the stock and whether they are adding or reducing. Domestic mutual fund ownership has risen materially over the last year. As of SEP 2025, mutual funds owned a little above 7% of equity, up from roughly 4% at end 2024. In the SEP quarter alone, net purchases by funds were in the multi-crore share range, with more than 100 schemes adding and a smaller number trimming. The last sizable shift was around the late 2024 equity raise and subsequent 2025 weakness, when funds accumulated on dips. Pause. Let's talk about FIIs adding or reducing. And the last big move, foreign institutional ownership declined from mid-20s% in late 2023 to about 21.9% in SEP 2025, with the bigger reductions occurring in late 2024 and early 2025, partly dilution from the equity raise and partly profit-taking amid weather noise. In the most recent quarter, FII holdings stabilized and even ticked up marginally, signaling potential re-entry at lower prices by some foreign investors. Pause. Let's talk about promoter share contribution. Promoters held approximately 59.4% of the company as of 30th of Sep 2025. That majority ownership has persisted for years, with small movements reflecting capital raises rather than large secondary sales. Let's talk about whether the company is regulated by the government. There is no sector-specific price or output regulation on soft drinks in India. However, the business operates under standard food and beverage compliance, FSSAI quality norms, GST at high slabs on aerated beverages, state and local licensing, water use permissions, and plastic recycling obligations under extended producer responsibility. Internationally, similar regimes exist, including sugar taxes in certain African markets. Compliance is an ongoing operating discipline rather than a strategic constraint. Let's talk about growth outlook from the last two investor calls. Management commentary through Q2 and Q 2025 emphasized double-digit volume growth is realistic once weather normalizes. Africa should deliver mid-teens growth, as recently acquired territories scale. Snacks and alcohol distribution are measured but meaningful adjacencies that will add modest revenue in 2025 and more in 2026. And recent capacity investments in India provide ample headroom, reducing the need for outsized capex in the next 4 to 6 quarters. Near-term priorities include distribution deepening in rural India, premium pack expansion, and category innovation such as energy and dairy beverages. Let's talk about management guidance for the next 12 to 24 months. While the company does not typically provide formal numeric guidance, the directional view is clear. Sustain double-digit beverages volume growth, keep EBITDA margins broadly in the 22% to 24% corridor, protect and grow market share even at entry price points if needed, and selectively expand internationally where PepsiCo refranchises. New categories should be grown with discipline, pilots first, then scale based on unit economics. Pause. Let's talk about how much the future order book is looking here. As noted earlier, there is no order book in the traditional sense for a consumer beverages company. The forward visibility is reflected in installed capacity, distribution breadth, cooler placements, and pre-season stocking. The company currently has adequate capacity to absorb strong seasonal demand. Management has indicated that even a 50% surge in volumes can be supported without immediate major greenfield spending. So growth is constrained more by demand than by plant bottlenecks over the next year or two. Pause. Let's talk about the closing summary. Varun Beverages has compounded revenue and profit at strong double-digit rates over the last 3 years, widened EBITDA margin into the 23% zone, and deleveraged to near net cash. The 2025 drawdown was largely weather-related and appears transient given October's improvement. Valuation on PE and PB is demanding but sits within India consumer growth norms. On EV/EBITDA, it is closer to fair when set against growth. Key watchouts remain seasonality, input costs, and execution in new territories and adjacencies. With capacity ready, distribution deepening, and selective diversification underway, the medium-term setup depends most on a normal summer and disciplined execution. Treat this video as a starting point for your own diligence, not as advice. Pause.